This past year returned some amazing results for investors. There are some analysts that think 2025 will actually be another great year. What if there was a way to make money off of all this uncertainty? And that's what we're going to talk about today. Both JEPI and JEPQ are some of the biggest names in the income ETF space. But how can they be used in 2025? These are actually actively managed by JPMorgan Chase, one of the most important, biggest banks in the world. They have world-class professionals running the show. People like Hamilton Reiner, somebody that's been in the industry for 40 years. Both young and old. We even got Judy Jansen and Matt Benson in here, just 10 years in the industry. So these are actively managed. They're going to have a little bit higher of an expense ratio than just some passively managed ETFs. JEPI and JEPQ both around 35 basis points expense ratio. So just $35 for every $10,000 invested. That's not too bad. So JPMorgan Chase actually just announced blowout earnings. They had a great earnings report, smashing Wall Street expectations with record profit and revenue. So I wouldn't be worrying about this fund going under anytime soon. Now, these are the two JPMorgan Chase ETFs that are utilizing covered calls. It's essentially a trade of some capital gains in exchange for guaranteed payments up front. Investors are very nervous for a volatile 2025. Even if the stock market is very volatile in 2025, that doesn't mean that JEPI and JEPQ can actually make investors money. You see, if you just buy and hold a stock, really the only way that you're making money is if the investment goes up in share price. But with JEPI and JEPQ, there's a way to make money even if the stock price goes down. Now, many view income ETFs as a safe haven because even if the stock market goes haywire, these funds should give at least some return. This is a diversified basket of stocks. JEPQ has many of the big tech companies, while JEPB has some of the biggest, best companies found in the S&P 500, some of the 500 largest companies in the United States. Think of these investments as a basketball team. Even if one player is ice cold, most likely others on the team are going to be able to pick up that slack. Now, if the NASDAQ or the S&P 500 do very well, the dividends can certainly be fat, but they will give up some of that capital appreciation. This is because JEPQ and JEPB are doing covered calls. They're giving away the rights to someone else if the stock price meets certain conditions by a certain date. Let's use a 2025 example. Let's say there's this really hot AI stock. Some are saying, oh, it's way too overvalued. Some expect it to drop later this year, but others are thinking, you know what? This might actually go to the moon with its innovation. JEPQ might do covered calls at a certain strike price, but if the stock doesn't perform as well, then JEPQ still gets to keep the shares and the premiums for doing the options trading. So some slow and steady growth is certainly possible with this ETF. Now let's say though that the AI stock and the rest of the market also takes a huge tumble. While we have certainly lost some value because of the stock price falling, it's not all bad news because we still get the options premium from doing the covered calls. That's a locked in profit that will happen no matter what. What happens in the short term, it doesn't matter. We locked in that profit. That's where I can see these having a place in a portfolio. For those who might not be super bullish on the market for 2025, there's a chance at some capital appreciation and a chance at some high dividends. But here's the risk. What if the AI stock price just explodes?
I just exploded.
What if there's this brand spanking news that there's going to be all this business with a new customer or new technology and the stock price has just really went to the moon? Well, unfortunately, we have already made our bed. We have traded in a lot of those returns for a chance at some income. Now, the PEG ratio or the PEG ratio, this is the price to earnings growth ratio. It is a valuation metric that compares a stock's PE ratio to its expected earnings growth rate. It helps assess if a stock is fairly valued, overvalued, or undervalued by factoring in future growth prospects. Now, some analysts are saying that PEG ratios are actually fairly priced right now in the stock market. That means we might actually see a lot of growth in 2025. Nobody has that crystal ball though. Nobody knows what the future holds. But others are worried about all this trade talk, the new administration coming in, the Panama Canal, tariffs. All that might bring the market down. Now, just like any other investment, where one person is in their life, their age, their goals, their family size, where they live, that's going to all impact if this is the right investment for them. For those invested in the long run, entry points don't really matter. It doesn't really matter if you think the stock market will go up in 2025. That's very short-term thinking. It's normal for the stock price to just go up and down over time. The income from covered calls, they're likely going to be taxed as ordinary income. Thus, it's taxed at the highest bracket. There's really no tax efficiencies there. But it's also possible to hold these in tax-sheltered accounts. It's also possible some of the distribution will also be qualified. Now, equity-linked notes, or ELNs, they also make up a small chunk of these funds. With ELNs, there's a chance at some counterparty risk. This is something that people don't really talk about too much. Now, counterparty risk with these ELNs, this is referring to the risk that is the issuer of the ELN. They might default on their obligation. It's also possible others could fail to make the required payments to the investor, either at the time of maturity or during the life of the note. If you're still unsure about what ELNs are, just remember that they're a type of investment where the return is tied to the performance of a stock or an index. It's structured pretty similar to a bond, meaning that it also offers some fixed income. Now, that's what you like to see in your pockets. Now, if the stock or the index performs really good, you could potentially make some money. But if it doesn't, your return could be lower or it could even be negative. A covered call income ETF like JEPI, they use ELNs to boost its income by taking advantage of stock price movements while limiting some risk. By using ELNs, JEPI can earn extra money on top of its regular income from things like covered calls. This helps JEPI give investors higher returns, especially in markets that aren't growing super fast, but are still a little bit up. Essentially, ELNs help JEPI earn more money while keeping things safer. Now, the stock market, it actually did correct in 2022, but JEPI, it actually did better than the overall market. One could spread their investment across both of these ETFs. There's no right or wrong answer here. Again, JEPI and JEPQ, they both seem to be pretty solid products based on their track record, how the funds are structured, the people running it. It just really depends on an investor's goals. These are just tools one can use to get to their investing journey goals. That's going to look different for every person. JEPI may be for the more faint of heart. There's going to be more stable companies. There's going to be a little bit less income every single month from those distributions, and there's going to be some protection. JEPI has around a 7.5% dividend yield in 2024. That's actually better than the rate of the 10-year treasury, believe it or not, but it's also underperformed the overall market in terms of just capital appreciation. Now, those that want to take on a little bit more risk, they may invest in JEPQ. There's higher yields, but there's also slightly higher risk. JEPQ can offer around a 10% yield, but it's going to vary a lot based on market volatility. There is no such thing as a free lunch. Anybody who tells you there is very misinformed. Of course, past performance doesn't guarantee future results. So you have to ask yourself one more time, do you want a chance at some income versus a chance at missing out on some potential big gains? You need to understand these risks before investing in these products. Find the right mix for you. All right, are you buying JEPI and JEPQ in 2025? Let me know in the comments below. Thank you to all my Patreons. My videos are always found in podcast form under the Collect Cash podcast name.